What's up, financiers? ENL Finance here, coming at you with another video. Penny stocks. That's all we see on YouTube. Everyone's looking for the next booming penny stock. It makes you think, are penny stocks really worth investing in? In this video, we'll be going over how we use penny stocks to create steady income. But before we begin today's video, please don't forget to smash that like button. It really helps the channel out, and if you're new, welcome to the channel where money makes money. Back in November, we made a video on different cannabis stocks. One in particular was a penny stock called Sundell Growers, ticker symbol SNDL. During this time, we bought 100 shares for a cost of $19. That means each share only cost us 19 cents per share at the time. Then the stock boomed to its current price of approximately 66 to 68 cents per share. We bought an additional 100 shares for a total price of $65. We did this so that we can have 100 shares to create cover calls with and another 100 to keep just in case the stock booms again. And now with our 200 shares, we started to play with option trading to create cash flow with our covered calls. For those that are new to investing and all of this sounds like a different language, let me explain. Penny stocks refers to a small company stock that typically trades for less than $5 per share. Penny stocks can be a risky investment. That risk can be tied to many things, such as a new company to the market, a new idea that investors are afraid to invest in, or service or product they provide has not yet made a profit. Penny stocks should be purchased with caution due to its high risk. What we're doing with these penny stocks are we're creating option contracts. An option contract is an agreement between two parties to facilitate a potential transaction involving assets such as stocks at a preset price that the buyer has up to a certain date in order to buy these shares. As the seller of the option, we are then obligated to hold and sell the stock to the contract buyer if the buyer decides to execute their option to make the purchase. They can only do this if the stock price reaches the agreed selling price. So in order to sell an option call, you need to hold 100 shares of the company you are creating this option call for. Since each agreement is to sell 100 shares of a given company to someone that's looking to buy into this company in large amount at a specific price point. Remember, we are selling contracts, not buying them. There are option traders who buy contracts in order to resell that contract at a higher price than they bought it. If you want to take part in what we're doing, first, you need to buy 100 shares of a penny stock. Ideally, you want to aim for a price point under $1 to minimize losses. Then choose an expiration date close enough to reduce any chance of that contract being executed. Even if the contract ends up being executed, we still make a profit from the premium holding fee in addition to our payment for the 100 stocks at a profitable price point. Remember, we bought the stocks low in order to make contracts to sell them high. The goal is to continue to make these contracts that stand a difficult chance of being executed by selecting an expiration date that expires in a week or 2 weeks. Although there is more money to be made with longer contracts, it gives the buyer a higher chance of getting the stock for the price that they're looking for. And as the seller of the contract, we can either benefit from continuously making these contracts or having them execute at a higher price point than we bought our original shares at. How this works is, if a stock was to cost 65 cents per share and is rising to 70 or 80 cents in a trading day, it will cause contracts for the week to be more expensive. This is because any contract that, let's say, is for $1 or above is now more likely to happen for the person that's buying this contract. But at the same time, if the stock was to fall from 80 cents to 60 cents per share, then the person that paid for this contract at its peak price during the trading day just lost out because now the contract is cheaper than it was before. This is because the stock price got now further away from the $1 agreed upon price. As the seller, we stand to benefit from the peak price the contract calls because of the premium the buyer is paying up front. This is what we like, short contracts with high buy and sell volume. Where there's a higher chance of the contract failing, we get to keep the money the person paid for the contract and the 100 shares to keep creating more contracts after the expiration date of the contract we just created. We recently had a contract expiring on the 22nd of January, in which we agreed to sell the shares at a price point of $1 or $1.01. The person that wanted this contract paid a premium, which just means we cannot sell these shares to anyone else other than them. But the contract ended up expiring under the agreed amount, so we end up keeping the premium and the 100 shares so that this upcoming trading day, we will be able to create a new contract and collect on this new premium for this contract. This is how we are creating a continuous cash flow. But what if the price did hit $1 on the 22nd? Then what happens? What happens is the person gets to choose to buy the 100 shares at the price of $1 per share, in which we profit from the difference of the $65 that we spent versus the $100 that they spent acquiring our 100 shares. So if the contract would have executed, we would have profited $40. $35 comes from the difference between what we paid and what they paid, plus we pocket the money that they spent on the premium. Being that we had 100 shares, we not only profit from the contracts being executed at a price higher than what we originally bought the shares, but we still have 100 shares to create more contracts with, or keep it while the price continues to rise. Remember, the goal is to make money off the attention that penny stocks are currently given. So if you are creating an option contract and you see one like this one, which pays you $23 for creating a contract that sells 100 shares at a price lower than its current price or what you paid, be careful. The upfront cash might be a lot, but you lose the long-term cash that these 100 shares can create. Let us know in the comments if there's any penny stocks that you like, or if you're a fan of option trading. Thanks for watching, and if you'd like to chat with us or have any questions, you can follow us on Instagram, Facebook, and Twitter. Links below. And as always, if you find this information useful, don't forget to smash that like button, subscribe to our channel, and set your alerts to receive more content like this one. See you guys on the next one, and remember to follow the 3 M's. Money makes money.